It is a portfolio which says I don't expect the last 10 years to be replicated in the next 10 years. I think there will be a change of guard, and I'm playing to that.
Hello, everyone, and welcome back to the Personal Investor Podcast. I'm Ed Monk, and I'm joined today by Fidelity Investment Director Tom Stevenson to talk about the sorts of funds that you can buy and forget about for 10 years. More specifically, we're going to be running through the 10 funds that Tom himself has chosen for this very task. Before that, let me remind you that if you find this video useful or interesting, to please subscribe to the channel, give us a like and leave a comment if you want to do that. And once you've subscribed, remember to hit that bell icon at the top of the page to turn on all notifications so that you get new content as soon as it is released. That all said, welcome along, Tom. Hello.
Hi, Ed.
I'm going to say right at the start, Tom, that we're going to be talking about a whole range of different funds today. So if you're watching this or listening to it and you missed them, there is a written article, isn't there, written by you, Tom, that has details of all these funds. Importantly, we have to say these are not personal recommendations. We are not suggesting anyone buy or sell or hold any of these funds. They are simply... Except you. They are simply a bunch of picks that you, Tom, have made that potentially fit this brief that we're going to talk about. And we're going to start there, if that's okay, Tom. Why did you set yourself this challenge of picking 10 funds for 10 years?
Well, apart from the fact that it's a good headline... Don't
give the game away.
That wasn't the main reason. No, so I did this a year ago. So I was sort of in my early 60s. I thought, I don't actually know, if I'm going to at some point buy an annuity, but at some point in the future, I will probably de-risk my portfolio. I kind of thought I want to have a good 10 years in which I'm going to get some exposure, ongoing exposure to the stock market. I don't really want to spend a huge amount of time thinking about it. I'd like to sort of, lock them away, hold on to these funds. And so I set myself the task. I said, look, if you could only buy 10 funds and you had to hold them for 10 years, what would they be? I just thought it might be an interesting exercise.
I think it is an interesting exercise and actually a valuable approach really to investing for all sorts of reasons. It sort of acknowledges something that's basically true about investing, which is the less you do, often the better, right? I mean, the less you tinker, the more you can leave things alone. That's a virtue when it comes to investing, certainly versus lots of in and out and tinkering and changing.
Absolutely. Actually, interesting you should say that, because yesterday I was playing around and I another of these sort of thought exercises. I thought, I wonder how many FTSE 100 companies there are in the FTSE 100 now that were in the FTSE 100 in 1984.
Yes.
And what would have happened if you'd bought those? So that's an even more extended example of just doing nothing.
Yeah.
And there were actually 30 of the 100 companies were in the original list in 1984. So I created a little index of those 30 funds and ran it through to see what the performance was compared to the FTSE 100. And it was actually much better, to your point.
Yes.
It was those survivors turned £100 into £1,600, whereas the FTSE 100, well, we know it started at 1,000, it's just gone through 10,000. So basically 100 into 1,000. So it was actually 60% better buying the survivors. So you're right. Sometimes doing nothing is the right thing.
Indeed. Now, as you say, Tom, this exercise is a year old now. We're a year into it. You first made these choices last year. Remind us of the framework that you used to select these funds. What was the sort of lens through which you were looking for this?
Yeah, I mean, again, slightly arbitrary, but I thought I wanted to have a mixture of styles, investment styles. So I was investing for 10 years. So I wanted to have an element of growth. I wanted to have some funds which were populated with growth stocks that were, hopefully going to deliver good earnings growth over that 10-year period. However, I did feel that over the last 10 years or so, growth has had a really good run, and that it felt like the opposite investment style, the value investment approach, the sort of more contrarian approach, might actually have its moment in the sun. So I also wanted to put some value in there. So bit of growth, bit of value. I wanted some defensiveness as well, and that's another reflection of the fact that I was holding these funds for 10 years. So I wanted them to be able to, ride out the ups and downs of the markets through thick and thin. So there was an element of defensiveness. The two more categories. One was again, looking back over the last 10 years, great period of time for the US stock market. America has done really well, led the markets higher. Felt to me, even a year ago, it felt like there was a bit of a rotation happening out of the US into the rest of the world. I got that right. There has been. So my fourth category was to address this question, America or the rest of the world. I had two funds, one of each. Mm-hmm. And then my final category was, again, I'm doing this for 10 years. The world is going to look very different in 10 years' time. I don't know how it's going to look different, but I know it's going to look different. And I suspect that, a couple of themes will prevail. I suspect that technology will continue to be a dominant theme in our lives and in the stock market. And I suspect that emerging markets will continue to be a dominant theme in the growth of the world economy. So that was my fifth category.
Okay, so we're going to get into each of those categories and the funds that you picked and how they've done in the past year. Looking at that list, was it an accident that you've picked almost all active funds? I mean, there's a couple of non-active funds that we'll get to. Is that part of your thinking for the next 10 years, that active is a potentially better place to be than passive?
Well, I mean, that's a good point, actually. Well, it raises an interesting point, which is that these 10 funds they're largely equity funds, shares, no bonds in there. And there is a reason for that. The reason for that is that these 10 funds they don't represent my whole retirement pot. Yeah. So I also have an amount of cash, which I will continue to hold because, at this stage in my life, I want that sort of balance and that security. It's good to hold cash just from a portfolio management perspective, but also from a sort of defensiveness perspective in case the markets fall, gives me some dry powder in case the markets go down. So I'm always going to have some cash. So I felt quite relaxed about having my 10 for 10 being all in equities. And I suppose that same argument for why active. I was quite happy to take some bets with that money, given that I had the cash on the other side of the ledger, if you like.
Okay, well, let's get into the choices, Tom. The first of the themes you mentioned there was growth. So how are you defining that, first of all, and which funds did you pick for the job?
Yes, so it's essentially earnings growth. So these are shares which are perhaps not the cheapest. They are full of shares which are growing their earnings quickly, and therefore possibly you're having to pay a reasonably punchy price to get them. Some funds specialize in this growth style. So the first one that I chose was a fund which we've talked about many times over the years, the Rathbone Global Opportunities Fund, very much focused on these growth stories. And the manager, James Thompson, pretty relaxed about, paying up for that sort of growth and quality. It's done very well over the years. I mentioned earlier on that growth as a style has done very well. This fund has done very well. Actually, it was not quite the worst performing, but the second worst performing of the 10 over the last year. The other relatively poorly performing fund was the other growth fund, which was a Brown Advisory US smaller companies fund. So smaller companies, typically, it's the old adage, elephants don't gallop. Small companies have the ability to grow faster than large companies. I felt that small companies within the world's biggest and fastest growing economy had to be an area that would deliver some growth over a 10-year period. Again, in the short term, hasn't been great. Neither of them have fallen a lot, but they both lost a little bit of money over the year.
Well, I can give you those numbers. So the Rathbone Fund, 1.9% down over the past year. Amidst a very, very good year for markets overall. The numbers here show how good it's been. Brown Advisory, US smaller companies down 7.3%. at the beginning of the story over the next 10 years. So let's see what happens.
Pretty relaxed about that, to be honest. I mean, over a 10-year time horizon, the first year, is neither here nor there. And I did commit at the beginning to holding these for 10 years. So doesn't work out in the first year, I'm relaxed.
Okay. All right. Well, next we have the value component. Why value? You've answered the question a bit here, but why value, and where did it lead you in terms of the fund choices?
Yes, so it led me in a couple of different directions. Actually, one is into the sort of income area. So one of the funds which I've mentioned on many occasions, I've recommended more than once, is the Fidelity Global Dividend Fund. Good, solid fund, high quality companies within that fund. Deliberately, I chose it because it's got a bias away from the US. Yeah. It's for a global fund, it's very underweight the US. It's quite overweight Europe. There are no other explicitly European funds in here, so actually, I feel that's covered off quite nicely by the Global Dividend Fund. The other value-focused fund is the Dodge & Cox Worldwide Global Stock Fund. Bit of a mouthful.
Well remembered.
Actually, one of my recommendations this year as well. It was a recommendation last year.
In your 4 picks.
In my 4 picks for the year. That's right. So that's a different form of value. That's more of a contrarian fund. So it invests in stocks which are a bit out of favor, quite cheap. Sometimes they will also have high dividend yields like the Global Dividend Fund, but not necessarily. For a fund whose style has been out of favor in recent years, it's actually produced a very satisfactory performance and a very smooth performance. I really like that one.
Yeah, just on the Global Dividend Fund, 12.3% in the past year. The Dodge & Cox Fund, 12.5% in the past year. So they've already done well. The Global Dividend is interesting, isn't it? It happens to be a value pick now. It might not always be a value pick, right? I mean, it could be that dividend paying companies, there was many years, going back a bit now, but there was many years when dividends were really highly valued because of the income they paid. It hasn't been that way because people have been looking for growth and really fast growing forward-looking earnings. But certainly when you started this exercise, it was looking like a value play.
It is a value play at the moment, yes, and as you say, I mean, it may well change. I mean, in fact, that wouldn't surprise me if, especially in an environment of falling interest rates, as interest rates come down, then I suspect that those high dividend paying stocks will become more highly valued and more highly sought after.
Okay, the next theme that you picked on was defensiveness. Why, I suppose, and also where did it lead you? I can see these two funds are alternatives to the others.
Yes, so I think I can remember these. It's the global gold. It's the gold ETF.
iShares Physical Gold ETF.
Physical Gold ETF is one of the alternatives, and the other one is an infrastructure fund.
International Public Partnerships.
International Public Partnerships, indeed. Yeah. So both of them, they're both, they fall in the alternatives category, and their defensiveness comes from their lack of correlation. They move differently from the other equity funds within the portfolio. I mean, gold has been particularly good. I mean, it's helped my numbers enormously because it's been a fantastic year for gold.
59.6% when you pulled these numbers.
Yeah, so. That's right. So almost 60% in the year, and that clearly has dragged the performance up. I think the performance of the portfolio as a whole was about 17%, something like that.
I think it averages out that way. Yes.
Basically
very, very positive all over the place. Apart from those two that we mentioned at the start.
The growth funds that we mentioned. Yeah, it has been a good year, but then it's been a good year in the market.
And so where you say gold is the difference being it's much more positive than the very positive equity returns.
Yeah. I mean, it would have been a satisfactory return without the gold, but the gold is clearly, and actually this is an argument, isn't it, for diversification within a portfolio, because the chances, the more diversified you are within within reasonable bounds. So you obviously, you want to have a reasonable amount in each one to enable, if one of them really does pay off, you're going to feel the benefit. And that role was played by gold.
Yeah, international public partnerships. You're going to have to remind me. So this is a fund of company shares?
It's a fund of actual infrastructure projects. So they might be schools or hospitals, airports, that kind of thing. So it was really a play on the sort of the necessary rebuilding of the fabric of British society. They're mainly UK projects. This is a long-term fund, so this is a secondary point. But one of the reasons why it was attractive to me was that it's an investment trust. It trades at a big discount to the value of its underlying assets. So that's always a good characteristic of an investment trust, to buy it at a discount to its assets. It also, a bit like the Global Dividend Fund, it pays a high and, importantly, a growing dividend. So this investment trust has raised its dividend payout to shareholders every year, I think, since 2006. It's a long time anyway, about 20 years.
And that's the promise with infrastructure projects like that. You can have very sort of robust arrangements for income in order to fund them and get that investment into these long-term projects. And so a very different game from the stock market, for example. Yeah,
absolutely. And the other thing to bear in mind with it being an investment trust is investment trusts have the ability to hold back some income in the good years, so that when things are not so good, they can drip it out a bit. So that enables them to have this smooth trajectory of dividend payments, which we've seen with this one.
Okay, so the next one, Tom, is the theme that you mentioned about the US versus the rest of the world. What lay behind that, and which funds play to that theme?
Well, it was a bit of a cop-out, to be honest, because I genuinely didn't know. I knew that something was happening with this relationship between, the US and the rest of the world in terms of investors' appetite for those two areas. It felt to me like we were rotating away from the US, but I wasn't sure. So I kind of hedged my bets. So I had some US exposure. I also, for 10 years, I didn't want to not have some US exposure. But I didn't want to be exposed to the very expensive parts of the US market. So the way that I played it was to invest in one of these equal weighted funds. So it's the iShares, isn't it? It's iShares S&P 500 equal weighted ETF. And as its name suggests, it literally has 2% in all 500. Sorry, 0.2% in all 500 stocks in the S&P 500. So it has a different. It travels on a different path from the capitalization weighted S&P 500, and I hope that it will have a smoother ride given the high valuations of the Magnificent Seven tech stocks.
And it lags over the past year, but that might not tell the whole story. It's 1.9% higher than it was a year ago. The US market is some way ahead of that. But more recently, things might be different.
Yes. So, actually, those big tech stocks have continued to perform last year. So actually, the thinking behind this equal weighting hasn't yet paid off. But I suspect that what we've seen over the last 6 months or so, the Magnificent Seven has basically gone sideways, and the rest of the market has caught up. And the equal weighted has outperformed the capitalization weighted index over the last few months. So I suspect that if that continues, then those two will reverse. So that was the US side of the equation. The other side of the equation was I actually went for a UK fund. It felt to me like if there was a rotation out of the US into other markets around the world, then very likely investors would be looking for the cheaper markets in the rest of the world. The UK absolutely falls into that category. It's one of the cheapest markets outside the US. And the fund I chose was the Fidelity Special Situations Fund. That was one of the best performers last year. I can't remember the
27.8% on these numbers.
Yeah,
so, a value focused fund.
Yeah, so another value focused fund. Alex Wright, very good stock picker. It's been I've actually recommended that fund before in my picks for the year. And in fact, it's a pick this year. So, I do like that fund a lot.
Okay, and then finally, then the theme you've called a changing world or the changing world. A couple of funds here playing to that theme. So, what are they?
Yeah, so I mentioned the themes, didn't I? The technology and emerging markets. So the way I've played technology, again, coming back to what I was saying before about the highly valued Magnificent Seven tech stocks. So the Fidelity Global Technology Fund it's a global technology fund, as its name suggests, but it has a bit of an underweight to those US stocks. So it's a slightly more sort of there's a bit more sort of lateral thinking, I guess you'd put it, in terms of playing the technology
because
theme.
For 10 years, technology will have its say, won't it?
Absolutely. I mean, it would be a really eccentric portfolio that didn't have an exposure to technology, I think, over that period. So that's why I chose that fund. I can't remember what the performance was on that.
12.4.
Yeah. So okay.
Yeah.
Reasonable. And over the long run, it's been a very strong performer. So I would have reasonably high hopes for that one. And then the final one, the last of the 10, is the
Lazard Emerging Markets
the Lazard Emerging Markets Fund. And that is the third and final one of my picks for this year, actually.
Yes.
So the Dodge & Cox, the Fidelity Special Sits, and the Lazard Emerging Markets Fund. So this is for an emerging markets fund, actually, which is a volatile asset class, bounces up and down quite a lot. This has had a very smooth ride. We actually had the manager in, James Donald, recently to an event that we did. So some people watching this video may well have watched the video of that event, because we streamed it live. So he was very interesting man. Came in, talked about his investment strategy.
Had a great overview of the geopolitical scene. And obviously an advocate for emerging markets, but had that sort of holistic view of the world.
Yes, and actually not, his view of emerging markets is probably different from some other emerging markets investors' view of that market. So he's not quite so interested in China, although I happen to think that China is an interesting market at the moment. He's very keen on some South American countries, Brazil in particular. So that's quite an interesting lesson there as well. That you think, emerging markets, I'm getting India, China. Not necessarily. You need to look under the bonnet of what you're getting, because James Donald's view of emerging markets is a bit different.
A very good performer for you last year, Tom, 36.9%. I should say it's not all about 1 year performance, not by a long shot, right? I mean, that's just sort of by way of informing people how those choices have done.
Yes, I mean, I think it's good to keep an eye on them and to
we'll update,
remain
as we go
accountable,
along, yes.
and transparent. But as I said earlier on, I'm pretty relaxed about the short-term performance. Okay,
so before I let you go, Tom, just a couple of questions to throw at you as regards all this. One, looking at these choices, could you not actually frame this in a more simple way by saying basically a wide range of assets that underweights the Magnificent Seven? I mean, you underweight it, you have a technology allocation, but it underweights tech. You've got value plays, you've got dividends, you've got the smaller companies in the US, you've got the UK. I mean, Rathbone Global Opportunities is perhaps the one that really sort of makes a virtue of those big bets on those big, huge American companies. But in general, you've underweighted them.
Yes, I think that's a good observation. It is a portfolio which says I don't expect the last 10 years to be replicated in the next 10 years. I think there will be a change of guard. And I'm playing to that. So I am it's a judgment. I may not be right. You know, it's not a completely neutral fund choice.
And finally, then, Tom, looking back with a year's hindsight, do you think there's any stories you missed? Anything you regret not latching onto a year ago?
Yes, I think there is actually. I think the one thing which is not really covered there's no explicitly European fund, but as I mentioned earlier, I think that's quite well covered by the Global Dividend Fund, which has an overweight to Europe. So I'm kind of okay about that. There's no Japanese exposure there other than in the global funds. So I kind of regret that, and not just because Japan did extremely well last year. I think for a portfolio that's meant to last for a decade, I think not having one of the biggest economies in the world represented is a bit of a mistake. So if I were to change things around, I would probably slightly reduce the US exposure, because I've got a lot of US exposure through the Rathbone fund. I've also got the equal weighted fund, and I've got a US smaller companies fund. So even though I was a bit hesitant about the US at the start of last year, I think I'm still a bit over US. Wow. And I'd replace one of those with the Japanese fund.
Well, I'm afraid you're not allowed to do that, Tom, because you did say it was it's for 10 years this, so it's for keeps.
Okay, well then I'll stick with it.
Okay, that is all the time we have for now, Tom, so let's leave it there. I will just remind you all that if you found this useful or interesting, to please subscribe to the channel, hit that bell icon to get notified as soon as new content is released. Give us a like or share episodes. It really will help others find what we're doing here. That all said, Tom, thanks for joining me.
Thanks, Ed.